preference capital. So what do you mean by the preference capital? So name itself it is indicating preference means these are the part where you will be getting the preference, right? So see, as the name suggests, the holder gets the preference with respect to the dividend as well as the payment in case of the liquidation. Means, for example, see, if you are having the preference share, means what? You will be getting the preference where in the dividend payment you will get a preference, or in case of the company fails, right? Then after the liquidation of company, the while distributing the proceeds out of it, you will get the preference, right? So in case of a dividend as well as the proceeds distribution after the liquidation, you will get the preference if you hold the preference share. That means that is what the preference share are the part of preference capital, right? So this is the part of the capital which provide lesser risk to the investor as compared to that which is taken by the equity investor. So if you are purchasing the preference share, so you will always prefer, because you will get preference in the dividend payment, you will get preference in the to get the proceeds after the liquidation of the company. That means the name itself is a preference, so you will be preferred. That's why risk will be less, right? So this is all about the preference share capital. Now see, what are the main features of the preference capital? So see, first, it is a stock which is preferred over equity shares with respect to the dividend and the repayment, as it is the definition of it. It is always preferred over the equity share because the name itself is a preference share. The basic condition is that the preference should be given to the preference shareholder in case of the dividend and the liquidation proceeds. Next, unlike the equity capital, the dividend rate of the preference share is fixed, just like a debenture. That means what? See, in equity capital, dividend rate is not fixed. It depends on the if company is having more profit, more dividend, less profit, less dividend. But in case of the preference share, the dividend rate is fixed, right? It is just like a debenture. In debenture, you get fixed income, right? As a dividend, as a rate of interest, as a interest. In the same way, in the preference share, the dividend rate is fixed. Okay. Like equity capital, preference share are paid dividend out of the post tax profits. Post tax profit means, hence on the preference share the tax is not deductible. Means what? Simply see, for example, if you got the 500 as the sales, right? Out of that you have paid the taxes. So out of that you have to suppose you have spent 400 rupees and you only left with the 100 rupees. 400 will be your expenses, operating expenses. So only 100 rupees you are left. That is what your profit. But out of that you have to pay the dividend, you have to pay the taxes, right? So here, like equity share, preference share are paid dividend out of post tax profit. That means after that 100 rupees you are left, you have to pay the taxes. For example, say 18 rupees is the GST tax you have to pay, right? So 100 minus 18, that will give you around say 80, right? 78 rupees you will be left. So out of that 72, after the tax you have to pay the dividend, right? That means dividend are paid post tax profit. That means PAT, profit after tax, PAT. Then you have to pay the dividend from the PAT, profit after tax. Okay, very simple. Now there are cumulative preference share. So basic thing, what is a preference share? Preference share means the simply that shareholder which get a preference while paying the dividend and the distribution of the proceeds in the case of liquidation of the company. Now what do you mean by the cumulative preference share? So again it is very simple. The name just, it is a preference share, right? But it is a cumulative. Means what? See, first year the company profit is not that much of good, so you will get dividend. For example, here dividend is guaranteed fixed. For example, 100 rupees is the dividend, okay? But due to the economic condition, company doesn't pay for the first year. Second year they have to pay 100 plus previous year's 100. But second year also the situation of company is not good. Then in third year they will pay 100 plus 100 plus 100. That means current year plus previous year. That means if the situation of company is not good, they have to accumulate and they have to pay any time. That means in future they have to must pay. That is what the cumulative preference share means. What? The dividend is guaranteed. In other words, if the if in a year company does not have enough profit to declare the dividend, then it is accumulated to the credit of the shareholders and paid when in the subsequent years. So the distributable surplus is available. That means in the future, when they got money as a sufficient, they will pay the all the previous years dividend. That is what the cumulative means. They can accumulate it. Okay. So this is the same. Simply name you are by the name itself you are getting the meaning of the shares. Now see, redeemable preference share. Again, it is a preference share, but it is what the redeemable means. What these are those which get repaid as a part of as per terms of issue. Means while issuing itself, they are saying that you have to repay it. Means after some time you will get repaid like that. Okay. See, for example, if I have the FD in the bank, okay, for example for 3 years, so after 3 years I will get money back. In the same way, that shares can be redeemed. For example, see, all the preference shares are required to be redeemed within the period not exceeding 20 years. So what is the maximum period within that must be repaid or redeemed? Simply 20 years. Redemption has to be made out of the profit or out of the proceeds of the fresh share issue for such a redemption purpose. So how redemption can happen? How company can give the money? Only out of the profit. You submit your share, right, simply, or they will give you the money. Like that, the meaning of redemption. Okay, and that is must you have to redeem. That is the beauty of that share. That must you have to redeem within that period. Now, their company has choice. They can give you money out of the profit or out of the proceeds of the fresh share issue of such a redemption purpose. Or what they will do, they will issue the fresh share, you submit that share, and you will take the another share. Okay, price may be different like that. Okay, however, in case of the bank, perpetual debt instruments can be issued. Okay, but this is only for the bank. If bank is having some redeemable preference share, in such cases the perpetual debt instruments can be issued. Okay, what is that debt instrument that we are going to discuss? Okay, so the thing you should note here, under the current provision of the Companies Act 2013, companies limited by the shares are prohibited from issuing the preference share which are not redeemable. Means the company which is issuing the preference share, that must be redeemable. Okay, so it is important. The company which is basically listed by the share means the company which is listed in the stock exchanges, they have to issue the redeemable shares. Now, preference shareholder have limited right to participate in the voting only on some of the resolution as specified in the Limited Companies Act 2013. So they are having limited right for voting. So see, every shareholder will not have the voting right, but the preference shareholder will also get the voting right, but that are very limited. Means what? See, where dividend on the preference share is not paid for a 2 year or more, that means first year dividend not paid, second year dividend not paid, then you can participate in the voting. Because see, this is the provision only. First year dividend not paid, second year not paid, that means 2 or more year if you are not getting the dividend on the preference share, in such cases the shareholder will get a right to vote on all the company resolution, right? So if you are getting dividend timely, that means you are having limited right. But if you are not paid more than 2 years a dividend, then you will have a right to vote on the all company resolutions. Okay, so that means you can directly interfere with the company matter. That means you are not getting dividend, so you have right to get involved in the company for voting purpose. Okay, now why company raise preference capital? What are the benefit for the company by raising the preference capital? Okay, so that we will see. Now see here, it is a good source of fund for every long term period up to 20 years. So we have discussed that the redeemable preference share can be redeemed up to 20 years. So up to 20 years you will get time, right? So it is a good source of fund. That means company will get long period up to 20 years. It can be used. The money can be used by company. Mostly such security are privately placed, and hence the cost of raising the fund is not high. What is privately placed and what is the what is the openly placed? Means like a IPO. IPO is what? It is open placing, and privately placed means like Shark Tank. You know Shark Tank, right? Where they are directly asking, give me 50 crores and take the 5% of my company, like that. That is what the privately placed. And cost of raising means by the way of different rounds or by the way of IPO simply. Okay, that is what the openly placed IPO, and privately means like a personal selling. Okay, so generally the preference capital will be privately placed. That's why the cost of raising will be less, and there is no compulsion to pay the dividend unless the cumulative preference share are issued. So if you are paying the cumulative preference, right, that means your dividend will get accumulate and you have to pay anywhere, anytime in the future when you get the money, right? So but there is no any compulsion unless you are having the cumulative preference share, right? The recurring cost in terms of the dividend is fixed and it is known beforehand, unlike dividend on the equity. That means, see, you have to pay fixed dividend, for example 50 rupees, so so in that way you can manage the business. That means it is a recurring cost upfront, you are knowing it very well. The current owner do not have the dilute their equity, so obviously no need to dilute the equity. Give the preference share, they will get dividend, and we have to redeem it after some time if they are redeemable. So we don't need to share we don't need to dilute the equity, we don't need to lose the control over the management by diluting the equity. Okay, so no need of the selling the shares in the form of equity. It is a part of the net worth of the company. Why? Because it is a part of the capital, so it is a part of the net worth of the company, and hence helped in improving the debt equity ratio. Right? Absence of the voting right. Unless the company skip dividend for 2 or more year, it gives comfort to the management who generally does not like the interference. Obviously, if the dividend is not get for 2 or more year, then you will get the voting right, unless until you are not having the voting right, right? That means absence of voting right will be good for the management, they don't like the interference. Okay, now no security is provided to the preference shareholder, unlike in case of the debenture. Means what? There is no security provided to the preference shareholder, unlike in case of the debenture. So there is not that much of security. How it is different, that we will see when we are discussing the debenture. Okay, but there is no any security like to the preference shareholder, unlike debenture, because they are only getting the preference, but they are not getting the security. Okay, that we will discuss while comparing the with the debenture. Now in case of the infrastructure company, the period for redemption or the preference share can be more than 20 years. Okay, that is important thing. Only it is for the infrastructure company, because the project of infrastructure company itself, it is more than 20 years. Okay, long term projects are there. Now what are the drawbacks of it? So simply from the point of view of the management and the equity shareholder. So what is drawback basically of what? Of the preference capital. Now see, possibility of the management interference in case of non-payment of the dividend for more than 2 years. So obviously, if there is no payment of a dividend for more than 2 years, then voters will get right to vote, right? Shareholders will get right to vote in the any resolution of the management of the company. So possibility of the interference. Then dividend paid is non-deductible expenditure which increase the real cost of funding. So obviously whatever you are paying the dividend, you are paying profit after tax, and that after you have to pay the dividend. That means you are already paying the taxes, then you are paying the dividend. That means the dividend you are paying is not giving any benefit in the tax, right? It is non-deductible expenditure, right? So for example 100 rupees is a profit, 20 rupee you have paid tax, only 80 is left. From that 80 you have to pay the dividend, but you have already paid the tax, because the dividend is paid PAT, profit after tax. So while paying the dividend, there is no any tax benefit. Okay, then redemption reserve are to be created, leading to lower retained earning. So obviously see, if you are issuing the redeemable shares, you have to some money, you have to create some pool money, that is called as the redemption reserve. You have to we have to hold some money as in the form of reserve to pay in future. So whatever you're earning, that you have to supposed to pull in that account, so your earning will be get lowered, because you have to send some earning to that pool reserve account. Now, equity shareholders feel sidelined. How? Because the preference for dividend payout is given to the preference shareholder. So obviously preference will be given to the preference shareholder. So equity shareholder will get feel that they are sidelined. Okay. Now in case of the liquidation, these shareholders get a prior charge over the residual assets. So obviously in case of liquidation, the shareholder get a prior charge. Why? Because the preference share they are holding as compared to the equity shareholder. Now, it is definition of preferential share. Now, contingency of the voting right devolution to these shareholders create uncertainty and apprehension in the mind of the management. So obviously, right, see, you if you are not paying any dividend, the shareholder can do the voting. So it is uncertainty and apprehension in the mind of the management. They are having fear that so they will vote against anything, then how can we run the business? Okay, they don't management don't like the interference, right? So this is all about the drawbacks. Now we will see the term loan. So friends, this is very basic and theory part, right? You are very much aware about the term loan. So what is term loan? Term loan means obviously you are giving for some term, some specific term will be there, and generally it is for the purpose of purchasing machinery, plant like that, okay, or purchasing some tangible asset. So it is another major source of the long term finance. Generally it is provided for long terms, so it is a source of the long term finance. What is source? See, by availing the term loan, you are getting the money, so it is a source for you as a company, right? So it is the source of the long term finance. Apart from that, by which a company can obtain the term loan from the banks or the financial institution. So who will give the loan? The bank or the financial institution can give you the term loan. Generally, term loan are given to the finance for setting up or the expansion of the project, right? The financial institutions are allowed to give only such a loan which are repayable over the years. The term loan can be medium to long term, generally up to 10 years maximum. While bank also give the working capital finance. What is working capital? CC, cash credit is a type of working capital, right? The term loan may not be as costly as the working capital. Generally, working capital is for day-to-day activity. It is having more rate of interest as with respect to the term loan, because term loan is for setting the business. So after setting, they will take some time to generate the cash. But while CC is for working capital, so already business is established, they need more money for day-to-day activity. So cash flow already is there. But for term loan, they are setting the business, so cash flow will be after some time. So here the rate of interest will be more, and here in term loan rate of interest will be less. Okay. Now the main feature of the term loan are what? So we will see what are the main features of the term loan. Now see, period. So all the loans except the demand loan are generally the term loans, right? And they are generally granted for short to long term, right? Short term means what? Up to 1 year, or they have to pay within 1 year. That is the short term. Long term means what? 5 to 10 year, and medium term is what? 1 to 5 year. So 0 to 1, 1 to 5, and 5 to 10. 0 to 1 is called as the short term, 1 to 5 is the medium, and 5 to 10 is long term. Okay, this is the important you can note. Okay, and housing loan, for what period we are sanctioning? Housing loan we are sanctioning generally 5 to 30 years. Okay, this is very much common practice in our banking. Now further, what is the purpose of the term loan? Again, it is very simple: to acquire the asset which are tangible. For example, to purchase the land, to have the buildings, to purchase the plant and machinery, for setting up the project which are have a long and useful life. Okay, simply to purchase the asset we are giving the term loan. If the project is already running, the loan is taken for the capacity building or to build up the capacity for shorter period up to 5 years. Okay, that will be sufficient. See, you are having already the business, then you are taking the term loan. Why? To expand the capacity of the business, right? Then in such cases, up to 5 years, the loan repayment will be there. Loans are granted for housing and even for soft furnishing also. Okay, now let's talk about the interest on the term loan. So the term loan carry the fixed and the predetermined rate of interest. So rate of interest generally decided in the sanction order itself. Okay, Now the interest rate is negotiated and depend on the factor. For example, what period we are sanctioning the loan, what is the risk involved, what is the rating of the company, right? For example, say civil score, then what is the purpose of the loan? Depending on the bank will decide the rate of interest. For example, for a solar energy plant, so or the wind energy or any renewable energy, rate of interest will be less, right? So the factory like who is emitting the CO2, for that the rate of interest will be more. So it depends on different factors. Now the interest is payable in monthly or quarterly, or in sometimes maximum times it is in the form of EMI. EMI stands for equated monthly installment, and each EMI, it is a part of interest plus principal, then it has been distributed. Okay, it is very much common, you are aware it, right? The EMI amount contain both principal as well as the interest part. In certain regulated sectors, there are floor and ceiling rate for some rate of interest. For example, in some sectors there are some ceiling. For example, nowadays government is giving, for example, affordable housing scheme, where the rate of interest is fixed by the NHB. Okay, that means you cannot charge more than that. So ceiling is there, some ceiling is there. Okay, for example, loan to the self-help group, you cannot charge more than 7%. This is what the guideline, right? So in some cases there is a ceiling. Okay, now the rate also depend on the market condition and the competition. For example, the rate at which SBI is giving loan is not same as the rate at which, say, Indian Bank is giving loan, because SBI is very big bank, they can offer the lower rate of interest. Indian Bank is a mid-sized bank, they cannot offer the lower rate of interest, so their rate will be more than the SBI. Okay, now penal and additional or higher rates are generally charged for the if the payment is delayed beyond the agreement period. That means if you are not paid your EMI on timely after the due dates, you will get a penalty, additional and more interest rate. Okay, this is all about the interest of the term loan. Now let's talk about the repayment. So it is very easy. Generally loans which are term loans are repaid either monthly, quarterly or half yearly or yearly. Okay, in some cases where a bound acquisition of assets is there, there is recovery by the bullet payment. Bullet payment means what? For example, at the end of the period, they will repay all the loan in only one installment, bullet repayment. Okay, in only one shot. Okay, now what about the security? Obviously, you are giving some loan, right? So security must be there. Means what? The collateral security or the primary asset. So uncertainty over the long period obviously enhances the risk perception and also have the insecurity in the mind of the lender. Now, even otherwise, no lender can or will lend without the security of the securing the term loan by creating the charge over the primary asset. So what is the primary asset? Primary asset means simply the asset which are purchased by the way of a term loan. For example, if you have purchased the machinery, so machinery will be what? Machinery out of the term loan. So machinery will be the primary asset. In addition to that, you have given your personal house as a mortgage to the term loan, then your house will be the collateral security. Okay, collateral security means these are what? The personal asset of the promoter or the owner. Okay, so simply primary asset means the asset which are purchased out of the loan proceed, and collateral is what? It is the security taken of the personal asset of the promoter. Okay, now what is a tangible security? Means simply you can touch. Tangible means touchable. Okay, and tangible security are always preferred. Why? Because you can take the possession. A proper and independent valuation is supposed to be carried out by the lender, and title to mortgage asset and liquidity or salability also examined. That means you will do the searching. Search report will be taken right from the advocates to take the title deeds. Then you will have some mortgage, right? Then you will you check the salability, forced sale value you will check, right? All formality you have to complete in the security part of the term loan. Okay, now amount of loan. How much amount of loan you are getting in the term loan? So in case of the purchase of existing asset, you are having, for example, say housing loan you are going to purchase. Now it is existing asset. In such cases, independent valuation should be there. So valuer will do the valuation. Okay, providing a margin to cover the value fluctuation. For example, house, there is house is value having, for example, 500 lakhs, and plus or minus 20 lakh can be here and there. So the 20 lakh, so out of the 500, only 480 is remaining, because 20 lakh you have to subtract, because it is a fluctuation in the price, plus borrower's margin, and borrower is ready to pay 80. So only 400 is what the bank has to give the loan, right? So this is very simple. Now in case where the term loan is for creation of fixed asset by the borrower, the loan amount is availed or arrived by the debt equity ratio of the company. Okay, so if there is no existing asset, you are going to create the fixed asset from the loans proceed. For example, you are going to purchase the plant and machinery. In such cases, what we are having, only debt equity ratio you can calculate and sanction the loan. Next is what appraisal. So what is appraisal? It is the process of sanctioning of the loan. So the appraisal process depend on the size and the complexity of the project which you are financing. For example, big project, big corporation need a separate appraisal. Small project need a separate appraisal, right? For example, if you are giving the car loan, so very small procedure, even a branch manager can recommend and sanction. But if you are giving loan to, say for example, Ambani, Reliance Industry, so big proposal, different appraisal stages are there. Okay, so term loan is granted for examining the economic viability as well as the technical feasibility. So when we sanction the term loan, we should examine the economic viability of the project and technical feasibility of the project. Okay, this is all about the appraisal. Now WCTL, it is what? It is simple working capital term loan. So it is the very much combo of a working as well as term loan. Okay, interesting. It is very interesting. Now see, it is a type of the normal term loan, right, which is given by the bank or the financial institution. Okay, how see? It is not a type. Okay, it is not a normal type. That's why I told it is the very good combination working capital term loan. See, it is a term loan against the current asset. Okay, so generally we are sanctioning for the short period the working capital, but and the term loan is for longer period, but it is a combo product, working capital term loan. So when working capital loan given by the bank is not being properly serviced up by the borrower due to the liquidity constraints, then working capital term loan is given. Okay, got it? First thing. So see, if WCTL means what? If WC is not working, then you have to sanction the WCTL. Okay. Due to liquidity constraint, the cash credit account remains overdrawn. Right. To mitigate this liquidity problem, the bank agreed to provide a short-term loan under the head working capital term loan. Okay. And bank will fix the installment for the repayment. Now see here what happening. Suppose you have sanctioned the CC. Okay, CC is for example 50 lakh rupees, right? But due to some constraints, that CC always remains overdrawn. Okay, and due to this, there is chance that becomes NPA. So to avoid that, what bank will do? Bank will sanction the another, for example, say 50 lakh rupees the working capital term loan. Okay, so that it will benefit the CC holder, the borrower, as well as the bank. That CC will not go NPA. Another new business will get here. Now see, and that's new 50 lakh rupees you are sanctioning as the WCDL, working capital term loan. That will be generally for a shorter period, right? Generally we are sanctioning the term loan for longer period, but the working capital term loan will be for a shorter period. Okay. Now bank have to require to ensure the required current ratio depending upon the whether they have used a first or second method of lending. Okay, what is first method of lending, second method of lending, that we have discussed in the in detail in the credit. Okay, in the ABM, in assessing the working capital requirement. Now what is working capital? It is very much common. It is current asset minus current liability gives you the working capital. Okay. Now this is all about the concept you have to learn. Okay, no need to worry about anything because this is a complete theoretical part. Now what about the conversion? Conversion means what? See, you have taken the loan, right? You as a company, and you are not able to repay it. Okay, what bank can do? Bank will ask money. You say I don't have money. So what you can do? You will say you do one thing. You take my shares. Okay, you are having 50 lakh rupees. So I don't have money. You take these shares of 50 lakh rupees. This is what the conversion of the debt into the equity. So conversion of loan into the equity is not usually planned. So unless agreed upon by the bank and borrower beforehand. So it is generally not planned. If the borrower cannot pay the loan, it may restructure and a part of it is converted into the equity at the agreed price. So these shares have poor marketability and provide no return to the lender. Right? Why? Generally, because see the company is not performing, then why the share of that company will be performing? They will also not perform, right? So they are having no return to the lender, but give them a seat on the board to monitor the business. So they are having share, the bank will get a share, so bank person will be the on the board of the company to monitor the business simply, right? So best example here, I will tell you. See, the government of India has to take some money from Vodafone India, right? It was the case, real case. But Vodafone said we don't have money, right? So Vodafone has offered their share to the government of India, right? So in that way, they have converted the debt into the equity like that. Okay, in that case, it is simply the conversion of loan into the equity. Now, what is a moratorium? Moratorium means what? It is a time given for repayment of the loan. Okay, very simple. For example, if you have purchased a house, then you will get some moratorium, for example 6 months. Then within that you will not have to pay money. Okay, only interest you have to pay provided in the agreement. Now say it take a time for any project to start generating the cash flow, right? Positive cash flow and profit. The project will be if the project is the big project, the more time will take for generating the cash flow, right? For example, if you have set up the business, right, so it may take 2 year or 3 year to generate the cash flow, to generate the profit, right? So how you can repay the loan in such cases? Therefore, till such a time the borrower start generating the required cash flow, the lender give time to start the repayment, right? This is the grace period given by the bank. It is called as the moratorium. Okay, the moratorium is generally for the principal repayment, and interest is required to be paid as and when due, right? So generally we provide the moratorium only for the principal amount. It is mutually agreed for the moratorium for the interest payment, and some banks they also provide the moratorium for interest payment also. It is mutually agreement between the borrower and the lender. So it is very basic concept. Now what are the advantages? Okay, so basically what are the advantages of the term loan, right? So see, one by one, just I will go through it, you just have to look into it. Lender protect their interest, but borrower maintain the control. Why? Because borrower don't have to lose the equity, and lender will protect the interest by having the security in the term loan. Long term loans have future value and are like a risk capital. Obviously, long term loans have the future value, because see, you have given for example 5 lakh rupees now, and repayment is 10 years. So in that 10 year, how much amount you can earn from that business, right? So it is having future value and having like a risk capital. Okay, repayment over the time is cheaper due to the inflation. Obviously, considering the inflation, the repayment will be less. Tax deduction make the interest payment lower, and you will get a tax benefit. If you are having for example housing loan, you will get tax benefit, then interest payment will be lower. Submitting timely data help to improve the management and the corporate governance. For example, if you have CC account, you have to submit the stock statement, so there will be the automatically the good corporate governance in the business, right? Long term loans are cheaper than the equity capital. Communication with the lender is quick, so obviously you can reach bank anytime, right? The long term loans are cheaper than the equity capital. In the financial difficulty, loan can be restructured for extra benefit. So obviously if there is some difficulty, you can restructure your term loan. Now what are the another? Borrower also weighs in the following factors that are not in his favor. So what basically what are the disadvantages to the borrower? These are the disadvantages to the borrower of the term loan. Okay, now see, sometime interest rate can be lower than they appear due to the inflation, currency value, but the opposite can happen when the inflation is low. Some, so it is all about depend on the inflation. Sometimes you feel that I am getting the housing loan at 6%, because now the inflation is raised, but in the future if inflation increases then what, or inflation decreases then what? the rate of interest will remain fixed if it is fixed, right? So basically what I have to say, the interest rate can be lower than they appear due to the inflation. For example, right now I am purchasing the petrol at a 120 rupees per liter, right? So I will say 6% of housing loan is very cheap for me with comparing the price of the petrol or inflation. In such a cases, it may appear less, but the opposite can happen if inflation is low. For example, if I am getting the petrol, suppose in future 80 rupees, but my rate of interest will be 6. They remain same in the future because it is long term for 30 years. In such a cases, it may appear low or high. So that is the appearance about the interest rate. So another restrictive clause can hinder the organization's decision making, and companies with high borrowing are often rated lower. So restrictive clause can hinder an organization's decision making. So obviously there may be some restrictive clauses. For example, and companies with high borrowing are often rated lower. So it may happen, right? For example, see, there may be some clauses, terms and conditions, right? When we are sanctioning the loan, for example, we are purchasing machinery, so there may be some provision that you cannot ship the machinery from this plant to this plant, like that. That may happen, right? It is generally the part of the terms and condition of the term loan. In such a cases, it may have the some restrictive clause that may hinder the performance. That means that may affect the performance of the company, right? And some company with a high borrowing are often rated lower. That means if company having more they have borrowed more money, right, then the rating normally will get reduced, right? More the demand, more the inquiry for the loans, the rating gets decreased. In case of the falling business volume, too much debt can lead to the disaster, right? Obviously, you are having lot of loan, you will have chances you are leading to the disaster. As interest on the loan remains fixed and profit suffers. So obviously, if your business is decreasing, right, that means there is some recession, your business is not performing, then the debt can be the disaster to you. Loan, how you will pay the you will repay the loan, right? In such a cases, interest on the loan remains fixed and profit will suffer. Okay, these are all the disadvantages of the term loan while considering the view of the borrower. Okay, so friends, here we will stop. You can subscribe us on the YouTube. You have to join our Telegram group. Bankers Zone CIB is the name of the group on the Telegram. Also, you can download the application from the Play Store. Thank you, friends.